The banks were very happy that they passed the annual bank stress test review from the Fed. This led to wide-ranging advances in the financials. Jerome Powell has said time and time again that rates are still going to increase. The next FOMC meeting on the 26th of July has a near 90% probability of a 25 basis point increase. We've been tracking this since Jerome reiterated his stance, and it's a long-held stance from the Fed. What are the practical ramifications of this to financial markets? The federal funds rate will stay higher for longer, but it was always up there, and the target goal of 2% inflation was always years and years away. This, of course, was not good news for the tech sector, and we saw some retracement there. Looking across the market, financials did the best and communication services did the worst. We also saw that unemployment claims came in lower than anticipated. This reflects a strong job market. We also saw that the German CPI and the Spanish CPI came in stronger than anticipated. As I mentioned in episode 936, the global central banks are still pushing increasing interest rates. They're doing this to debake inflation expectations out of the economic system. How did the main markets respond? When looking at the NASDAQ and putting on our X-ray vision, we can see the NASDAQ closed out at 13,591, but it has smart money sell resistance at that 13,623 level. As soon as it gets over that, that could be definitely a fireworks time. But always have your three-dimensional thinking playing out at all times. The VIX has been really wobbly of late. And what is the VIX? It's the volatility of the S&P 500 or the fear gauge of the main market. We can see that currently the VIX is making a higher low. This is a low, this is a low, but this low is higher than that low. And that's why it's called a higher low. But when we look into the CTKS structure of the market, we can see that the VIX, which closed out at 1354, has had a heck of a time getting above this 1384 level. It is trying. What happened with the S&P 500? Let's turn on our X-ray vision and see where the smart money is buying and selling. What we saw was a bounce, and we anticipated this in yesterday's episode. We can see that there's upward momentum in the S&P 500. These lines come from analyzing all of price history from 1871 using the CTKS method. We've got some smart money support underneath the current price and a lot of smart money support. This is why we expected a bounce. A lot of people think that it just will hit an area of confluence and not dip below it. What you will find is price often dips below because you have climactic sells, and either way, in either direction, buys and sells, because the shorts get liquidated. But this methodology of looking at price action can give you signals unlike anything else. The thing to understand with these lines, and Art says it really well, as Art always says things really well, we are coming up on some major chart adjusting. I would suggest, and you do just what I do, is to reevaluate every single time period simultaneously. When you mark up your charts with the CTKS method, yes, it does take time, but that time is worth it. With the Fed reiterating its stance on increased interest rates, that we can expect some volatility, upwards volatility in the US 10-year, the US 2-year, and the DXY. That's going to be really hard felt by gold. And of course, the commodities. What do we see when we pop on our X-ray vision in the US 10-year yield? We can see that we've got a lot of smart money now resistance at that 3.851% mark. But when yields make their way above this and turn that to support, that whole dynamic could change. Always bear in mind, market structure is continuously changing. What do we observe in the US 2-year? The US 2-year yield absolutely sparked up. Now, why did it do this? We can understand it because of the structure inside the market. You can see there's a lot of fresh air up here. There's no smart money sell resistances, but there was a lot of smart money buy support down here. When you get above support like this, you can expect a slingshot upwards. We've seen it so many times. This is something to always be aware of. That's why you need to know where smart money is buying and selling. We always expected volatility inside the market. Anytime Jerome speaks, there's a problem because the adjustment of expectations creates a lot of volatility inside the market. And what did we see? The DXY found support down at that smart money buy area of 102,797, and this is significant. It plowed through this 103,1319 area, but was rejected by the 103,4926 area. Came back, found support, and it's going for it. We would expect more positive momentum inside the DXY, and that's going to affect so many things, especially with yields coming up, as we've observed. Rule 19 is a particularly important rule, sharp angles reverse. I'm going to go a little bit deeper into this rule today because I think it's really important. When we have a look at gold marked up since 1833 with the CTKS method, we can see enormous support around that 1898 level. When we talk about these safety nets inside price and price action, and you can see gold was up at 1911 at this particular point. You had all these safety nets, all this structure below. Why are safety nets there? Why do we mark them up? Because when things like this happen, we have to know where price could reverse from, where it could come down and we can get on the right side of the percentage. This creates enormous opportunities. As an investor or a trader, you know that all investors become traders anytime they buy or sell. Traders love to take advantage of safety nets, and investors often buy at ceilings. The best thing an investor could ever do is buy into the safety nets. Usually I start with these 8 charts, but I thought I would do it in reverse and do deep dives. What we can see is that the VIX is making that higher low at the moment. We know it has overhead resistance, but if it gets out of that overhead resistance, it could rally. We're also seeing a bit of a crossover in the NASDAQ, and we know the NASDAQ is at critical resistance at the moment. If it surpasses that resistance, and due primarily to AI, we could see some absolute fireworks inside the market, but also understand that the markets are very overextended to the positive side at the moment. Mean reversion is always something that you need to keep in mind. When it came to bonds and yields, finally we had a decisive break. We understand that the yields are on the increase because the market has finally understood what the Fed has been talking about for a long time. It's going to keep on doing what it's doing. This is also placing upward pressure on the DXY. It's also placing negative momentum on gold. When we look at Bitcoin in the background, Bitcoin has been doing very, very well because it's got a raft of institutional interest. Bitcoin is also a tier 1 chart, so we have to analyze it each day. It's really important to do so. Bitcoin is currently 30,474. We can see around this 31,000 mark, we've had a lot of rejections at the current time. That means that Bitcoin must start to trade above 31,000 to change its trend. The next smart money buy area is all the way down here at around that 29,250 mark. Turning to the longs and the shorts inside Bitcoin. The shorts got really excited, but then they said, well, that's not working for us, so they bailed. But we may see a bit of a resurgence in the shorts because the longs are losing confidence at the moment. A big thank you to Grubbers. We talked about positive excellence, and positive excellence is really important to gain a professional mindset in the markets. You will find that the majority of people lose money in the markets. It's not because they don't understand what they're doing, it's because of fear. Positive excellence is all about the mastery of fear, and Grubbiz says, positive excellence is a way of being in the world. The principles build the foundation for success and real wealth. And if we're not in alignment with those principles, it can be hard to sustain the success. Thank you, my friend. It's a really, really good comment. And one of the things you'll notice all the time inside financial markets, they're so volatile. Things are always moving around. And you saw that just recently with gold. I believe in life we have a very simple choice to make. We can either guess or we can know. I prefer to know rather than guess. And what can we know inside financial markets? Let's look at total crypto market cap. We can see total crypto market cap is currently 1.138 trillion. We had a smart money structural support level at 1.127 trillion. We unfortunately didn't get above this $1.153 trillion mark and made our way down to support. We went a bit lower, but tried to come back up. What we actually understand with the CTKS method, these lines are called Stanfield lines, or SLs. SLs are where smart money sellers and smart money buyers hang out. If you get the sellers overpowering, they'll push it down to the buyers. The buyers will then seek to push it back up to the sellers, and so the dance goes. This is why I say, if it's not going above, it's going below, and if it's not going below, it's going above. Now that we have an understanding of the main market and what Bitcoin is doing, and also what the DXY is doing, and yields and everything, gold as well, we can look into the crypto market. Most people, what they actually do, if they're crypto only, they'll just look at their beloved token. Say it's ADA, for example. They would just say, oh, what's ADA doing? And they would try to assess ADA's price behavior from ADA's chart. This is a huge mistake. Professionals think a completely different way. They understand that all markets and therefore all charts are intercorrelated and interdependent. This means that ADA relies on the DXY. It relies on the US 2-year, the US 10-year, the SPX, the S&P 500, the VIX, the NASDAQ, and of course Bitcoin and total. Professionals know it's not about being right or wrong, it's about synchronization. A professional will expect the best but prepare for the worst as well. This way, they don't do the retail roller coaster of emotions. They're already prepared. And they either win or learn, and they never blame. Blame stops learning. I would strongly urge everybody to make sure that you look through the Tier 1 charts each and every day. It will just help you out so incredibly. Over time, you'll start to see things that you first would not see. One of the things we understand, no alt can escape Bitcoin's gravity. You might say, Ken, well that's just crazy. Let's look at Bitcoin on the 1 second. Bitcoin is coming down. What's ADA doing? Oh, it's coming down. This is a 1 second chart, not a 1 minute chart, a 1 second chart. What is BNB doing? Well, it's coming down. Whoa, this is interesting. Bitcoin is starting to flatten out. Are they starting to flatten out? Are they starting to rebound a little? Yes, they are. Don't forget, this is a 1 second chart. You might say something like, well, Ken, what happened to Solana? Solana is just going for it. I'll just zoom in to recent price action and just give you a bit of a feeling how Solana's gravity is influenced by Bitcoin's gravity. What you can see is that Bitcoin's gravity is in fact dictating what kind of gravitational pull Solana is experiencing, but it's under-exaggerating the downplay and over-exaggerating the upplay. This is called directional correlation. Going into the 1 second view, we can see that we're starting to get a little bit of inversion, at least on the 1 second chart with Solana. But no alt can escape Bitcoin's gravity. If Bitcoin is coming down, Solana will come down. Therefore, returning to relativity and getting away from gravity, you can see that Solana's price is impacted by the direction that Bitcoin moves. This is a very, very important thing to understand if you're trading or investing in the crypto market. What does it actually mean? What's the practical application of that? It means that you need to look at Bitcoin before you look at any other alt. Should you just look at Bitcoin? The answer is no. You must at least, as a secondary, look at total as well. Total will at least give you an understanding as to where the markets have safety nets or ceilings. If you're in the crypto market, you may just confine yourself. If you were trading, for example, Solana, you may look at Bitcoin and total, but that's actually a mistake because junk bonds has an impact on Bitcoin. The DXY has an impact on junk bonds. The US 10-year and the US 2-year impact all of these things. You really need to at least look across the Tier 1 charts. How has the crypto market been going in the past 24 hours? We can see Comp doing really well, Solana, VGX, FTT, Bitcoin Cash, Serum, SRM, and a range of others doing quite well. A lot of people just look at something like this and say, oh, Bitcoin came up 1.22% or 1.21%. Okay, where's it going from here? If you don't know the structure, if you don't know where the safety nets and where the ceilings are, if you don't draw up those SLs, it would just be guessing. Let's have a look at the greatest gainers and greatest losers in the past 24 hours. CNNC has made its debut into the top 100, and it's rounding off CNT, which probably meant that a lot of people thought NC was CNT, so they just put money into both. We see it all the time in the crypto space, but they're up a lot. What else is up? Comp, Bitcoin Cash, Solana, BSV, Pepe, Curve, and XEC. One of the things we talk about a lot inside the masterclass, please do your homework. Just because something comes up doesn't mean that you should put your money into it. Let's have a look at Centurion. What is Centurion doing? Okay, well, we can't see too much about Centurion here. Let's go to their website. Let's check that out. Okay, what is it doing? Let's go to press. We got an error. Well, I'm going to put $10,000 into this. No question about it. No, I'm not. I'm only kidding. What do we see here? What is the web page like? Okay, it's got a couple of things missing, and wallet, and what is this? Oh, we can go to wallet. Two T's in wallet. Oh, that's interesting. And what do we see there? Okay, it would be, from my perspective, a big avoid. What about this one, Canation? Let's have a look at it. Let's see what Canation is up to. Having a look at the volume. Oh, $5.4 million worth of volume, raising the market cap by hundreds of millions of dollars. A lot of people think it takes $1 of volume to lift market cap by $1. I hope I've proven that to be completely incorrect. We talk about this a lot inside the masterclass. Let's go down a little bit more deeply. Can we see anything here? Let's have a look. Very, very little on here. Very little information. Let's go and check out their website. Oh, okay. So it's obviously cannabis. What are we seeing? Something interesting? Okay. All right. And do we see any terms of service? No. Any privacy policy? No. What about? What do we see there, apart from overlapping? Now, you've got to think about this. If you were an investor, would you invest in CNNC? Would you say, oh, look, it's just gone up so much, it's a sure thing? Personally, everybody is different, but I look into these two, CNNC and CNT, and you can see they're very different projects. Personally, I wouldn't touch either of these, but that's just me. I like to earn what I get and keep it. At buymeacoffee.com/cryptotradingks, we have a bit of a deep dive on Rule 305, assessing volume integrity. This is a really important thing for people to understand. There are a lot of different videos there, and I would like to thank everybody that's kindly reached out and bought me a coffee on buymeacoffee.com/cryptotradingks. Thank you so much, everyone. And especially to Raptors L, Suksan, and BWWC, and Rundle Ridge. One thing that I would also like to warn you about, if you're on social media, especially platforms like Twitter and YouTube, just don't get sucked in. If people talk about some particular project and you see it just getting tweeted everywhere, I would avoid that project like the plague. If you want to get into that project, make sure that you do your due diligence. For example, if you're going to go on holiday, you would research all over the place. What is the best flight? What are the destinations you want to go to? What hotels do you want to stay at? You may look into a rent-a-car. You may look into so many things, so many different activities. But the most important thing for you to do is do the research. When it comes to putting our money into things, a lot of people don't do any research at all. They just look at the price and say, oh, it's going up. Each day I can find the greatest gainers and greatest losers to the top 100. But just because it's there doesn't mean it's safe. It may not be. It may or it may not be. Always work under the assumption it may not be. The major difference between professional thinking and retail thinking is that retail is into luck and gambling. It has quite unrealistic expectations of profitability. How do you get realistic expectations? How do you stop just relying on luck and gambling? You learn, and that's the only way we can do it. It therefore takes time to become professional. Retail often starts off with very low knowledge. Professionals have very high knowledge. How do you move from low knowledge to high knowledge with persistence, dedication, and commitment? We all start as retail. We just have the choice. Do we want to become professional? I believe the main thing that costs retail the most is they only look at a few charts, specifically the charts they trade or invest in. Then they use recent indicative price and story-based analysis to just confirm what they feel will go in their direction. They don't look to what could go wrong, they look to what could go right. As professionals, we don't do that. We look at the market pulse, tier 1, tier 2, tier 3. We look at the structure of the market. We just observe what price is telling us, and we don't overlay our particular bias, because our bias is one of three dimensions. It can go up, it can go down, or it can go neutral. When we look at price reality, we look at the reality of price. We don't get selective. We don't do stories. We stack probabilities, and that's a completely different way to do things. Probably the greatest difference between retail and professional. Retail buy on green, and they tend not to do a lot of research. Professionals buy on red. That's a completely different mindset. It's a really good thing to discuss inside the comments. What do you see as the difference from your own personal opinion between retail thinking and professional thinking? And you can look at that from an investment perspective or a trading perspective. Building up knowledge is a lot like building a house. You have to start with a plan, and slowly things will come together. But you have to put in the hard work. A lot of people think that you don't need to do hard work at all. You can just gamble or have a lot of luck or do a lot of hoping. But life doesn't work that way, especially inside financial markets. You have to know what you're doing. That means make learning your focus. Along the path, you will get life pullbacks, but when you get these pullbacks, they're setting you up for the next life rally. Always bear that in mind. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.